Hello, dividend growth stock investing friends. It is Colby, the DGI Crab. Happy Friday to you. Congratulations on getting through your work week. Back again with the Friday video where I'm going to go over each of the 60 high quality dividend growth stocks this channel focuses on. We're going to look at the four tiers. These 60 stocks are split into categories based on your age and your time horizon, the most important metric for being a dividend growth stock investor. We're all about passive income here, not trying to time the market. What we want to do is build up a nice stream of passive tax advantage income over time so we can free ourselves from the rat race. Maybe when we're going through some hard times, even have a little bit of money coming in just to help us out with the bills and stuff temporarily without having to sell any stocks. How great is that, y'all? So we're going to go through the strategy this week, and this week it's going to be a little bit different. So what I have not been doing up to this point is showing you exactly how I'm investing. So what I've done is I've opened up a brand new account. I'm going to be investing $100 every single week into that account using this exact strategy. You can follow along and see that this strategy is quite effective. Now, I'm not a professional financial advisor, so don't take this as advice. Do your own due diligence when you are investing in anything. But how does my personal strategy work? Well, the DGI Crab allocation strategy is 50% of my money goes into age-appropriate ETFs. I'm looking for stocks that are yielding 30% or more above their 4-year average yield. My top 10 favorite stocks yielding 20% or more above their 4-year average yield is good enough for me because they're just that good. Now, I'm going to remain within my tier unless there is a stock in a different tier that's yielding 50% or more above the 4-year average. And if there's no buyable stocks in my tier, then I'm just going to add more to ETFs so I can continue to build up that passive income stream without taking a risk on what might be an overvalued stock. So that is how we break it down. What are these tiers? Well, if it's your first time here, tier 1 is for the 18 to 30-year-old investor. We're looking at this age range to acquire 1 to 1.5% starting yield. And typically we're looking for a dividend growth rate of at least 12% cumulatively. Focusing on the valuation tab here, where I am comparing the 4-year average yield to the current day yield to figure out if I've got something that looks like a solid buy. If it's in the green, it has hit that 30% or more undervalued threshold. Yellow is in the 20 to 29%. Still not a bad deal, but maybe not the greatest deal. And everything in the red, am I selling? No, I'm not. I'm just holding on to these stocks. I'll let the dividends reinvest to gradually build up those positions, just in case my particular timing is incorrect. I would still like to build those positions one way or the other. So right now, tier 1, we're still looking at Nike as the most undervalued stock. Nike is still trying to recover from that epic crash that it suffered over the summer. And it's probably going to be at or near the top of this valuation metric here until it gets back up above $100 a share. Right now it's sitting at $82.92. You can get a 1.78% yield on cost compared to a 4-year average of just 1.09%. So really good deal here. Nordson's still looking like a pretty nice buy as well. It is not quite at that 30% threshold, but 29 is pretty good. Not too bad. So I wouldn't be opposed to taking a good long look at Nordson again. Tier 31 to 41, or tier 2 is 31 to 41 years old. These investors are looking for yields usually in around that 2 to 3% range. We still want to get dividend growth rate in the high single digits. And for this group of stocks, the largest group of stocks in the tiers, and the one I am personally in, is still sitting with Hershey at the top of the list. Hershey is remarkably undervalued, if you ask me, and I have been really enjoying building up my position in Hershey over these last few months. Target, not a terrible value, but I'm probably just going to pump the brakes a little bit on Target and let that price dip a little bit lower than the 156 that it's sitting at right now. And then everything else here, we are just going to hold and continue to reinvest dividends and not add any new money to them outside of dividend reinvestment until we can find a better deal. Tier 3, age 42 to 53-year-old investors looking more for a starting yield in the 3 to 4% range. Still want to get solid dividend growth, but maybe 5 to 7% is a little bit more appropriate for the time horizon here. Archer Daniels Midland and Hormel Foods have been in the green for a little while now. They've been very close together, but now we've seen some separation as Hormel has climbed up a little bit to above $32 a share. Still a very nice value here if you ask me. But Archer Daniels Midland has had a rough week this week, dropped all the way down to 56.40 here at the close of the markets this week. I think both of these are really nice deals, 3.5% starting yield on both, with 50 or more years track record of increasing those dividends. That's what we like, increasing passive income that we can sleep well at night with. Tier 4, 54 and older investors, we want a higher starting yield here. We've got a shorter time horizon to retirement. We've really got to actively work on building that yield up. 5% at least starting out is what we want cumulatively of this group of just 10 stocks. And I don't want to throw dividend growth rate out the window. You still want to be able to have those dividends keep up with normal years of inflation. So you still want to get around 3% overall growth on that yield, because when you're not reinvesting the dividends anymore, you still want to get those pay raises. That's sort of what that's all about. But definitely not any good bargains here in this group of 10. The high yield stuff has just not been on sale for the last several months, you guys. Sorry to break it to you, but there are some excellent alternative options in the ETF space that I'm going to get to in just a moment. I will always just take a quick swing by my top 10 tab. Now, this is not a new group of stocks. These are all found somewhere in tiers 1, 2, or 3. These are just my 10 personal favorites. If I only had a portfolio of 10 stocks, these would be the 10 that I would keep. And if any of these hit that 20% mark, get into that yellow range, these are the ones that I'll go ahead and buy regardless of the tier that I'm in or anything like that. And still nothing to be had here as far as bargains, unfortunately. So now let's talk strategy. As I said at the top, 50% goes into ETFs, 50% into the individual stocks. Now, you can replace these ETFs with similar styled ETFs if you've got some that you like better, but these are my personal choices here. For Tier 1, I do 25% into the S&P 500, 15% into a small cap value ETF, 5% into a dividend appreciation fund. I really like VIG for that, and 5% into international stocks. I don't hold any non-US single stock, but I do put 5% into VYMI regardless of the age tier. I like this one the best for non-US holdings. Really nice ETF with a lot of holdings in it. And for the single stocks, as we looked at how they kind of shaked out here, if I'm in that tier 1 category, I'm going to go 45% Nike, and maybe dribble a little 5% into Nordson. You could do all 50% into Nike at this point, but I think Nordson being 29% undervalued is close enough. Tier 2, this is what I did this week. I'm going to show this to you guys here in just a moment here, but we've got same 4 ETFs, just different balancing with them. I'm doing 25% VIG, so I want to start building up those dividends now. Not abandoning the S&P 500, still doing 15% into that, 5% into the small cap, and 5% international. This time around, I'm doing 45% into Hershey, and because Nike is still 60% plus undervalued, I'm just throwing a little 5%er down into tier 1 so I can keep building up a Nike position just a little bit. I think it's worth it at this point. Tier 3, you want a little bit higher yield, dividend-focused ETFs. I really like these 3, VYM, SCHD, DHS. I think they're all fantastic. You could do an even split among those 3. You could just pick one if you think one is better than the other 2. These are just 3 suggestions of ones that I think are very high quality. That can give you some really good results. And then on the single stocks, if I'm in this age range, I'm going to do 25% into ADM, 20% into Hormel, and then even though Hershey is just shy of that 50% undervalued mark, I think it's just such a good deal right now. that I would even dip down and throw a little 5%er into Hershey, because that starting yield, I mean, guys, you're getting a starting yield at just shy of 3%, which is, right around where you want to get that starting yield metric anyway. I just think there's a lot of room for recovery on Hershey. And then for tier four, we're going to continue like we've been doing the last few weeks with the ETF double down. With tier four, usually my ETF breakdown is 15% into SPYD for the stock exposure, and then 5% each into some alternate investments like high yield bonds, preferred shares, MLPs, covered call ETFs, and then international once again. Now, since there's just nothing in that tier four category that looks viable right now, I would just double down on all the ETFs. So instead of 15 and a bunch of fives, we'd have 30%, 10, 10, 10, 10, 10. I wouldn't double down on the non-US stocks. That leaves a little extra 5% left over. Throw it wherever you like. If you've got something in one of the lower tiers that you like, great. If you want to even put more into one of these individual ETFs here, that's a fine choice as well. You're getting a lot of high yield and monthly payers here in this tier 4 category, so don't be bummed out if there's not an individual single stock right now that looks like a great deal for you. You're in your older years too. You don't have time to take those risks. Let's just load up on ETFs that pay us out a nice yield. And while we're in this hot stock market, you'll continue to build up that passive income one way or the other. So now, as I said at the beginning of the video, I'm going to do something new here now. I'm going to be adding every single week $100 into this portfolio, and this is what I purchased. It's exactly what we just looked at here. 25% VIG, 15 VOO, 5 VBR, 5 VYMI, 5 Nike, 45 Hershey, right? So here's what that looks like here with Hershey. We've gotten, and we're doing partial shares here. I'm utilizing Webull for this. I've never been a Webull user before. I'm still kind of figuring it out. So I'm going to track it here on this spreadsheet. When I get a little more comfortable with the user interface on Webull, I may, just open that up and show it to you there. But the phone app is very easy to use. The desktop, not quite as intuitive, so still kind of working through that. Bear with me. But this is what the breakdown looks like with 45 Hershey, 25 VIG, 15 VOO. So it's just as I broke it down here, 100 invested. And then what that does here, I'm tracking the dividends that it pays out every year. So this is what each one pays out per share per year, and then how many shares that I have, and then that shows me the annual income that these positions are going to afford me. So what I've done here with the $100 is I've acquired $2.35 of forward annual dividend income. Might not feel super exciting at first, but as time goes on, as all of these positions continue to increase the dividends that they pay out at their expected rates, including the ETFs, then this number is going to go up exponentially. It's the dividend snowball, very powerful thing. Maybe take a look at my video dealing with the dividend snowball. You can see it for yourself. I break down all of the numbers on a spreadsheet to show you what kind of growth that you get long term. Because eventually you'll get to the point with these dividend growth stocks that they are yielding more passive income for you and reinvesting than you're actually actively putting into the account yourself. It will start to out earn what you are earning. Now that takes a while. We're building a house of bricks here, not a house of straw. We're not cutting corners. This isn't get rich by Tuesday, as my friend Ari Gutman likes to say. This is get rich slow and steady, and you will absolutely win the race this way. I'm very confident in that. Putting my money where my mouth is, and this is where the first week of the official DGI Crab portfolio stands. If everything stays the same between now and next Friday, we're probably just going to see a double down on all of these, and we'll see another 235 go in, and if we get some dividend increases, that'll continue to go up as well. So very excited to be able to show you this portfolio. similar to the great ETF race series that I do every other Tuesday, where I'm showing you how you gradually buy ETFs and how that builds up your passive income. I want to do that here with this strategy too. I think it will make this strategy that I am doing for my portfolio a lot clearer to you. And then hopefully you can see the progress of it, and that'll motivate you to do something similar on your own. So that is it for the week, you guys. Thank you for tuning in. Email me questions at dgicrab@yahoo.com. Take care.